Good morning, everyone, and thank you very much for joining me. This is the Morning Market Review. It's Tuesday, it's the 4th of October. My name is Russell Shaw. I'm a Senior Market Specialist at FXCM, and my email address is rshaw@fxcm.com. I'm just going to bring up the high-risk investment warning, and if I can just get an idea that you guys can see the screen and hear me. Still paranoid from last Thursday. So just want to double check we're all good. Okay, excellent. Very good. Thanks, Joachim. Hey, Anna. Morning to you. All right, let's bring up the market commentaries disclaimer. And just the references, FXCM Market Scope, Trading View, and of course, Bloomberg. We'll start off with the Bloomberg email, which is 5 things to start your day. First headline reads as follows. Just before I get to that, let's bring up this chart here, which is the real rate. And some interesting things happening here. This is what we've been talking about. This is actually quite a surprise, but to me it's a surprise. We'll talk about that in a moment. Okay. So the first headline reads, wild gyrations. Shares in the Swiss bank giant Credit Suisse plummeted 12% to an all-time low on Monday after a weekend of fevered Twitter speculation about its financial health, before they regained almost all of the losses later in the day. The wild gyrations show the difficulty for Credit Suisse in managing the febrile confidence of investors as it rushes to devise a repair plan for its investment bank, which has been on the ropes since suffering massive losses last year from backing Archegos Capital Management. The price investors have to pay to ensure the bank's debt hit record levels, leading some to harken back to the fear-driven days of 2008. So they lost $5 billion with that Archegos Capital, and I looked at the share. We looked at the share price yesterday. It's 60% down on 2022, and it was, I think, 22% down in September alone. Next headline, Truss issue. Liz Truss will struggle to drive through key parts of the economic revolution she's planning for the UK because her standing in the ruling party is already so damaged, members of her cabinet said. Less than a month into her premiership, the minister said Truss has failed to take basic steps to line up support for her plans, such as putting them to cabinet debate, and expressed doubts about the way she manages the ruling Conservative Party. They asked not to be identified criticising the government. One former cabinet minister predicted Truss will be gone within a year to allow the party time to regenerate before the general election, which must be held by January 2025. And that's at the latest. Third headline, game of chicken. As Vladimir Putin's game of chicken with the US and its allies over Ukraine escalates into a new round of nuclear threats, the smaller weapons that his officials have called on him to use may provide vital hours or even days of warning, while Russia's long-range missiles and bombers are kept on constant alert, ready to fire in just minutes to ensure they aren't destroyed by a preemptive strike. Lower-yielding tactical weapons are locked up in about a dozen warehouses across Russia, and it would take time to transport them to launches. US and European officials have said there's no sign of any such preparations, but the Kremlin has sought to sow fear with hints that further escalation may involve arms that haven't been used since 1945. All right, just a few more things to read here. North Korea has fired a missile over Japan. I think we'll just, let's skip that one. European shares are on track to climb after a US stock rally boosted sentiment, with weak manufacturing data quelling fears of more aggressive Fed policy. All right, that's important. European shares are on track to climb after a US stock rally boosted sentiment. Okay, so there's a massive start to the fourth quarter, with weak manufacturing data quelling fears of more aggressive Fed policy. And I think that's very much what we're seeing here. So keep that in mind when we discuss it. ECB Governing Council member Mario Centeno speaks at a conference in Luxembourg. John Williams, Loretta Mester, and other regional Fed presidents speak at separate events. The Warsaw Security Forum starts in Poland, while the World Aviation Festival, billed as the most important aviation technology conference, will get underway. And that's in Amsterdam. Expected data includes Spanish unemployment, Acuity Brands reports results. I think next week, US earnings season starts. That's going to be very interesting. All right. So we've been taking a look at the real rates for a fair amount of time now. What we have spoken about just over the last week and a bit, is the fact that the real rates are looking overbought, and not only are they overbought, there's now talk that the Fed's not going to be as aggressive, and that's leading to some movement into the markets. And this is all, this is all stuff we've postulated. For example, the clearance of the overbought condition is now being reflected in US dollar, right? So the US dollar coming down very much lines up with the fact that the real rates coming down. We know there's a strong positive correlation there. The obvious question to ask is, are we going to go back and test this upsloping trend line? If it does test it and it holds, there is a switch up from what we call a tentative trend line to a valid trend. Technical analysis, it's something I recall very clearly that was in the notes for the Australian Technical Analyst Association diploma, and for some odd reason, 3 touches make it valid and 2 touches make it tentative. What effectively a trend line is got nothing to do with a trend. It's really a measure of the momentum of a trend. We've got an uptrend here. That uptrend is measured by the lower trough, by the trough, peak, higher trough, higher peak. The trend, the momentum is defined by this line. Now, where the analysis becomes really interesting is, of course, if we can start shifting gradients here. So if the gradient shifts like that, well, then we've got not a new trend. The trend's up, but we would have a new momentum that we can look at. But right now, it's fairly flat. I wonder if this normalization in the overbought condition hits this trend line. If it hits the trend line, well, of course, dollar needs to reflect that. And if dollar needs to reflect that, then, of course, the majors reflect that. They appreciate against the US dollar. Again, this is something that we suggested has a strong chance of happening in Q4. But what's interesting to me is that the overbought condition is now almost searing. So it's Tuesday. This candle here isn't a complete candle. It's an active candle because we're looking at the weekly chart. So if there is any sort of movement up in the real rates, then it pushes RSI back into overbought territory, and then we remain overbought. But if we close with a long red candle down here. Then we've got this overbought condition cleared. And once that overbought condition is cleared, I think it sets up the platform for the uptrend to continue. So that's the tension that we are monitoring at the moment. I didn't expect the clearing out of this overbought condition so soon into Q4, but lo and behold, it seems that that's what's happening, right? And that is being reflected in a number of instruments. So, of course, pound benefiting from the pullback in the dollar. I think there was also an element that the top tax bracket, the 45% tax bracket cut, that's been scrapped. So I think there's sort of maybe a double action there, but I think that the actual stronger action was dollar related as opposed to pound related. That's my general feel, because if we go through to say Aussie, all right, there's that strong movement. Okay, that's evident in pound. So what's the common denominator? US dollar, right? Go to euro US dollar. Okay, it's up. What's the common denominator there? US dollar. So I think that it's really the flushing out of that overbought condition, which is having a direct impact on US dollar and an indirect on the rest of the market. So there's that chain of causality that's flowing through. That's what's happening right here. That implies we keep an eye on this. When does it finish pulling back? And the way that we suggested would be a good way to monitor this, actually on a daily chart. Okay. And on the daily chart, looking at the 9-period EMA as a signal line, we don't actually need it. On the daily, it's really clear, hasn't it? So that was a surprise to me. Nevertheless, that's what's happening. That's what we're going to have to focus on now. If there is a pullback in interest rates, if there's a pullback in the US dollar, well then there's a number of implications for the market. So we've gone through to the baseline here. So here's the dollar, okay, in the top left corner. So we've got 12 charts here that we so we can go through the market really quickly here. So we've got dollar coming back, euro moving up, pound moving up, okay, Aussie moving up as well, perhaps not quite like the euro and the pound, nevertheless starting to move up. Take a look at US dollar coming down against the loonie. Even cryptos, we won't speak too much about Bitcoin yet, but it's moving up. US dollar Swissy starting to roll over. US dollar Japanese yen, I think, is now, I actually think US dollar Japanese yen's out of play. If anybody's got US dollar Japanese yen on their watch list, I think you've got to think long and hard whether you want to keep it on your watch list, because there is opposing forces here. There's going to be a high probability of a trading range here, because the finance authority is going to be defending this level, and dollar strength is going to be defending this level. So you kind of looking at a range. So you're going to have to adjust, instead of a trend strategy, to try and job between resistance and support. Much harder to do than trading trends. So I think US dollar Japanese yen has sort of really lost its allure, and it's completely unsurprising, you know. So there was always going to be intervention here. It was just a matter of when. So now that intervention's in, just think if you're watching this, just bear in mind the chances of a trend here have fallen remarkably. The chances of a range have improved remarkably, right? Now here's where it gets interesting. DAX and S&P, right? So DAX moving up, S&P moving up. Let's bring up NASDAQ here. Okay, NASDAQ moving up nicely. What's influencing the DAX? What's influencing the NASDAQ? The interest rates coming down. Interest rates coming down, that has a positive effect on present values in the time value of money calculation. And that's exactly what we spoke about in the past. This normalization, we've spoken about, I think, in the recent past, right? So this normalization in the RSI, well, we're now seeing that reflected in dollar. We're now seeing that reflected in the majors. We're now seeing that reflected in the risk markets. Okay, what's the implication? The implication here is if this is corrective in nature, and again we're going to have to monitor it, then it's a dip. It's going to be a dip in an uptrend. So again, remember we spoke about that false sense of security where there is going to be a ton of media now that we're going to have to sift through, suggesting, are we at the market low? Has the Fed now stopped raising rates because there is poor manufacturing data? All this kind of obstructive reporting, because it's an uptrend. The Fed has said we're going all in here. So these corrective movements must be compelling until proven otherwise. So we're going to carry on monitoring that. Then this is also an interesting one. Okay, back to oil and gold. So gold, of course, also it has a symbol, a ticker that is really exactly the same as a currency. You can look at gold in terms of it being a currency, where XAU would be the base, USD would be the currency. XAU is 1 troy ounce per US dollar. US dollar now pulling back. Why is it pulling back? Again, real interest rates pulling back. Well, that's got a benefit numerator, and you can just see how the dollar is moving up. And until there is confirmation of something fundamental changing in the real rate, I think that a trend line is something we're going to keep an eye on, because it may evolve from a tentative trend line to a valid trend line. So that's sort of the next step in the exercise. Let's just take a quick look at oil's very it's very tricky, because there is a meeting in Vienna, I think tomorrow, for OPEC Plus, and they're probably going to cut by I'm not sure exactly what the number they're talking about now, but initially 1 million barrels per day was bandied around, so a cut of 1 million, and they're looking to push the price of oil up. This is not as easy as, right? If we go through to a longer-term trend, let's bring up Brent. So where there was clear uptrend from where from the capitulation, following from the lockdown, there was a nice, really strong movement up here. That's finished. Okay, so that strong movement's finished, to the point there's actually a trend down, lower peak, lower trough. You can see the low trough, but now there's going to be interference by OPEC on the supply side. So there's a lot of variables in flux here. I think it makes it quite difficult. And the question comes, well, which is going to be the stronger variable? Is it going to be the demand destruction, or is it going to be the decrease in supply? And if the technical trend has anything to say about it, well, then it's going to be the demand destruction. But take a look what's happened just in this last candlestick. There's a gap up here. So what does a gap mean? A gap's in motion, right? So what effectively happened is we closed at $85 per barrel Brent, and we opened gapping up because of the prospect of that OPEC plus intervention. So this is going to be one to watch as well, but it's quite tricky. We've moved now into the clearing out of an overbought condition. It's a time for us to really try and stay level-headed, because we're going to get bombarded with a whole lot of news about counter trend, reasons for counter trend movements. Some of it may be valid. We've got to try to be savvy enough to filter what seems an appropriate report and what's just sort of written to justify the market movement. What's happening now is that there is just a normal technical correction in play. I don't see any changes that are fundamentally based yet. They may be there, but my view is it hasn't changed. It really now depends on the moderation of median CPR. Without that, I don't see any way that underlying fundamentals can shift. So we want to watch that, and if there's no change, this is a probable, not a definite, but a probable dip, and we'll see if we can exploit that. All right, just a few announcements. So Friday, we've got the live trade. We've got the live trade for non-farm payroll. I'm actually just bringing up the registration link, and of course everyone is invited. So if it's something you want to participate in, you're absolutely most welcome. And you just click on the link. I'll just pop it in now and register. So that's the first announcement. Second announcement, of course, is Thursday would be the third in our day trading workshop, and I'm looking forward to that. And then just a final announcement. So tomorrow there won't be webinars tomorrow. Both of them will be cancelled. Okay, so the crypto and the money market review will resume Thursday, and then we'll do the workshop a little later in the day. So that's the sort of announcements. Let me just see a few of the. Let me just take a look at. Okay, some good questions here. Anisfus, can we just take a look at the median CPR? Yeah, let's bring that up. And then Rob's just asking about spot oil and UK oil. All right, so let's just take a look at median CPR first. I'm going to put in United States here. I think should find it. Yeah, there we go. Okay. We can get rid of that. We can get rid of that. So this is the median, and at the same time, let's just put in the core. Let's put in the core CPI as well. And I don't like this one. Sorry, let me just find another one. Yeah, this one. Yeah, that one's better. Okay. Just making it a little bit easier to see. I will make it a red and thicker. All right, so this is the core CPR, and you can see whilst there was a dip here, okay, well, there's a dip here, it's kind of pushed back up here. And the pushback up here, I think, is a concern, but what the Fed is trying to do, they don't use CPR, they use PCE, but you know, they're very closely correlated. So they're trying to push this down to 2% roughly. But you can see the median, which is the inflation series for all the it's the inflation number right in the middle, right? So it's not affected by outliers. Okay? So you can have a high number at the top, you can have a low number at the bottom. That's not going to affect median. It's going to affect mean. Okay, the mean calculation gets affected by outliers. Median calculation doesn't. That's the advantage of looking at a median series. And as long as this doesn't moderate, as long as there's no moderation here, okay, there's going to be a flaw. So what the Fed will be, might be able to do, they might be able to bring the outliers down. So maybe we'll get the outliers down. But if the median doesn't moderate, well, then there's a flaw. Okay, that means that 2% target's going to be facing huge amounts of headwinds. So that's the median here. So this, I think, is very important. The next question from Rob is, well, which should we trade, the spot or the future? So let's instead of taking a look at UK oil, let's just take a look at US oil. I'll tell you why in a moment. And the reason that I am choosing US oil, Rob, is because let me see what the low was here. So you can see here, I'm not sure even if this pricing is fully reflective, but on the futures market, US oil actually went negative. Okay, so on a derivative contract, it went negative. On a spot market pricing, you can't go negative. How does a spot pricing go negative? It's not possible. You'll hit zero and it will stop in terms of pricing. There's actually I'll just mention this just because I find it interesting. Doesn't really mean anything. So you kind of got two types of distributions. You got something called a normal distribution, and then you've got something called a log normal distribution. A price is always going to be log normal. They'll never be normal. Percentage changes will be normal. Prices will be what we call log normal. And the reason is that they can't go below zero. Okay, so they bounded. That zero's there. So that's like a log normal distribution. So the idea is the spot market will never ever go below zero, whereas the futures market, being a derivative, does in extreme circumstances go negative. And the reason that it goes negative is because US oil is stored in a place called Cushion, which I think is in Oklahoma. And Cushion, at the time of the the lockdown period, was full to capacity, was full to capacity. So on a futures market, they were basically paying you to store the oil. That's why it went negative. But on a spot, it never went negative. I guess so. That's really the big, I guess, the big difference. Which one do you want to trade? Generally, I think the oil markets and the commodity markets generally gain a lot of benefit from futures market. I think a lot of the demand supply forces are reflected in the futures market as opposed to the spot market. Whilst there might be sort of differences between the two, just the mere fact that you can hedge. So basically, an airline would hedge their jet fuel on the futures market, which is impossible on a spot market. So there's just that's kind of the activity there. I'm not sure if that's answered the question, Rob. And they both sort of solid markets, but the liquidity, I think, in the futures market is just something to consider. So I hope that helps. Any other questions? Also, one more thing about futures. So if you take a look at something like the CRP index, like the Thomson Reuters CRP index, or you look at any kind of commodities index, they're deriving the prices from the futures market, not from the spot market. So if you're looking at an index in part of your analysis, you're looking at the futures market effectively, Robert, and there can be differences. And the differences can be reflected in what's called, just to kind of throw in a little bit of complexity, there's something called contango and backwardation, which we're not going to get into right now, but let's leave it at that. Yeah, exactly. So Rob's saying the liquidity and hence the spreads, key takeaway. Exactly. All right. Any other questions? All right, let's wrap up here, guys, and we shall speak then again on Thursday. Looking forward to that, and then we have workshop number 3 on Thursday. Cheers, guys.